It's such a great pleasure once again to welcome Mohnish Pabrai to this conversation and our forum. Our members will certainly know that Mohnish has shared his wisdom with us very generously in the past. And it's kind of a cliche, but he really doesn't need an introduction to MOI Global. Mohnish has managed the Pabrai investment funds for a long time now, has a great track record. And as we decided to do this Meet the Author forum, I realized that we had actually never talked to Mohnish about his book, The Dhandho Investor. Before that, he had a book called Mosaic, which I also enjoyed, but that's maybe for a future conversation. But the Dhandho Investor has really become a classic in the investment world. In fact, as I went through it again, I realized just how many concepts the people that we have interviewed have talked about without ever attributing them to Mohnish, because they've become so well accepted, you know, like uncertainty is not risk. And others that it's just fascinating. So Mohnish, thank you first of all for bringing this book to us in 2007. I think you've made a lot of investors better because of it.
Well, thank you, John. Yeah, so actually my objective in writing the book was to actually just crystallize some concepts in my own mind. And, you know, like they say, the best way to learn is to teach. And so actually, I found that the process of writing the book actually helped me kind of, you know, kind of formalize the principles and such. So it was a useful exercise for me. And I'm happy to see, and I'm happy every year I get a nice check from Wiley, and it's always fun to see that. And they recently came out with an edition in India, and I think that sold very well as well. So it's been vastly better than expected. So thank you.
The classic example that I think most know is the Patel story in the hospitality business, as kind of an illustration of what Dhandho really means. If you would tell that one succinctly, or if you prefer another illustration of what you really meant with this concept.
No, I think the Patel story is a great one, because I think it illustrates the concept really well. And in fact, in a number of conversations with Charlie Munger, he always brings that up, and you know, kind of reminds people never to try to compete with the Patels in the motel business. But basically, I think just taking a step back before we delve into the Patels is, you know, for me, the kind of the starting point of interest in investing and value investing was really a quote by Warren Buffett, where he said that I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor. And actually, the parts of your brain that gets used, whether you're running a business or making portfolio decisions, is the same parts of the brain, and the frameworks are very similar. Unfortunately, I think what happens in the professional money management business is most professional managers have never run a business before. And I think that's a pretty serious handicap because they're missing a significant framework. But if you have an investment manager who's had experience running one or more businesses, they have a significant leg up versus their peers. So basically, the book basically said, okay, so there is a lot of kind of cross-pollination between being an investor and being a businessman. And so I said, why don't we talk about some business people, because the way they approach capital allocation and running a business just directly dovetails into how an investor ought to look at kind of their investment decisions. And one of the first examples I used was the Patels who came to the U.S. in the 70s as refugees because they were being evicted from East Africa, Uganda, etc. And in fact, what has happened in the last 12 years since I wrote the book is the Patels have continued. So when I wrote the book, they had about, kind of 40 to 50% market share. Basically, all the motels in the US, approximately half of them were under Patel ownership about a dozen years ago. That number is probably approaching north of 70 or 75% today. And the second thing that has happened is the Patels have moved up market. So what used to be them just being in the kind of low-end motels, they've gone into the Marriotts and the Hyatts and the Hiltons, and they've done a masterful job, because in all the cases, whether it's a motel or any of these other types of hotels, their kind of competitive advantage has always been lowest cost operator. And low cost is going to give you an edge in pretty much any business you go into. And it's very, very difficult for non-Patels to compete with Patels on cost. I think it'll be, it needs to be in your DNA for several generations to operate like that. So, which is why they keep gobbling up more and more share. So the Patels had a very specific approach to when they got into the motel business, which is that they were not interested in taking risks. So they didn't have very much money because a lot of their assets were confiscated by the state. They came with a few $1,000s, and buying a small motel did a few things for a family. One is it gave them a kind of almost a free place to stay, because they would take a couple of rooms and the family would stay there. The second is it would give employment to almost the entire family, because hotels are labor intensive with room service and maid service and all of that. And the third was that they could lever their investment. Bank would loan them maybe 70-80% of the purchase price. So so the combination of those, coupled with their ability to run these places lower than anyone else. So basically, once a Patel took over ownership of a motel in a given area, they would quickly survey who their competitors were and what they were charging, and they would underprice versus all their non-Patel competitors. And the competitors had a difficult time matching the Patels, because matching the Patels meant that you would lose money. And so the underpricing basically led to higher occupancy. And even though they were underpricing, they were making just as much money or more than their competitors. So over time, as these motels prospered, they took the kind of capital it was generating and they kept buying more motels and kept handing them over to family members and such. And a very small community, Indians make up, let's say, 1% of US population. The Patels, who are, from a very small part of Gujarat, my guess is probably less than maybe 10% of the Indian population. So you have something like 0.1% of US population controlling 75% of the motels. And anytime you see a phenomenon like that, you should ask yourself kind of what's going on. And so that's kind of a big kind of quick intro to the Patels. And of course, the book delves a little further into their history and their methods and so on. And but that was the crux, which is that, you know, you look at a business, you create a competitive advantage, and then you're off to the races. And in investing, you're trying to do the same thing. You're either trying to buy a stock very cheap, so you can, you know, kind of make money when it gets fairly priced, or even better, you're trying to buy a great business which is underpriced, and then, you know, that business continues to kind of increase in intrinsic value, and you do very well by holding it.
Mohnish, I'm fascinated by the Patel story. One thing, it seems very much understandable that when you have a family basically living in a hotel and working, that you are going to be the low-cost provider. But it sounds like they've been able, or some of the Patels have been able to scale to multiple units where it can no longer be the family doing all the labor. They actually have to hire labor. How have they still been able to remain the low-cost provider and to kind of ensure that the competitive advantage remains intact when they're basically managing people at some point?
Yeah, so I think the game plan the Patels used was that as they started expanding, they would kind of depute one of their relatives who'd been, let's say, being apprentice or being trained in the mother motel, if you will, and you know, that individual had been kind of well versed in the looking at every minute cost. I mean, what would happen typically in a non-Patel motel is, let's say, for example, you know, you needed repairs to a water heater. You know, they would go about doing things a certain way, but the Patels, I think, would have spent the time to, you know, cultivate the relationships and make sure that they watch their pennies when you know, they're looking at the expenditure. So the key was not, for scaling, was not that they were employing family. The key was that they were watching the minutia very carefully. So they looked at every expense, kind of, you know, zero-based budgeting, if you will. I mean, they looked at every expense and say, okay, is this necessary? Can it be done a different way? Are we optimizing kind of what's going on here? And that sort of thing. And so the intense focus on cost was something that came very naturally to them. And it was somewhat unnatural for their competitors to be that intense on costs. And so you get an advantage. I mean, I would say that if you, the analogy doesn't quite work, but maybe it does a little bit, but like, no matter how much most full service agency insurance, auto insurance companies try, they're going to have a delta versus Geico in terms of cost because of the direct model. And that delta has actually grown because of the internet and so on. So I think the Patels just keeping their nose to the grindstone, even when they have not had family members working there, and even when they've gone to full service motels, I think they just watch their pennies a lot more carefully than most operators and most businesses.
So it sounds like it's really a mindset that they've kept, and you mentioned zero-based budgeting, which I think is
yeah. They just look at every single line item with a fresh set of eyes and say, okay, we're not accepting any kind of, you know, old rules of how it was done under previous ownership. I want to look at, you know, the range of things, and of course they've had experience running motels, and they've looked at every line item earlier. So they've understood very well how to optimize. So, each company, it doesn't matter what industry you're in, but each company has a DNA. So many companies become really good at kind of top line and growth and profits growing that way. And a number of companies focus on the bottom line and they make their numbers work that way. So the Patels have always taken a much more intense interest in having a cost advantage, and then they've just used the capital that's coming in, because they also live very frugal lifestyles. So they were able to accumulate capital, and help each other, and then the banks over time became more comfortable lending to them because they just saw the historic default rates of this particular ethnic group or community was different from Joe Public buying motels and such. So all of that kind of snowballed into more and more of an advantage over time.
I'll ask one more, and then I'll see if anyone on the line would like to jump in with a question. Mohnish, one concept that has really been popularized, that you popularized, but now is used very broadly, is this heads I win, tails I don't lose much notion. And I wonder if that applies to the virgin Dhandho that you have in the book.
Yeah, so actually, I always get uh, attributed for that quote, and actually that quote is not mine. Uh, I took it from there was a professor at Harvard Business School. I think now he's at Tufts. A good friend of mine, Amar Bhide, and Amar wrote a very good book. It's called The Origin and Evolution of New Businesses. It's a great book actually to read if you're starting a business, because it again goes into all these nuances of how entrepreneurs don't take risks, and they're really going to deal with uncertainty. So heads I win, tails I don't lose much comes from Amar, who had actually mentioned it in that book. But I saw that approach fit really well for value investing. So even though Amar didn't intend it for value investing, he was looking at it more from kind of non-venture backed startups. It fit in very well, and that's the key. I think the key with investing, even with Buffett and Munger, I think the first thing they look at is downside protection. So if we as investors, fixate and overdose on downside protection, the upside, many cases, just takes care of itself. But if you can put floors on the downside, then you've got a huge advantage. And so that framework, which is heads I win and tails I don't lose much, which is when things don't work out, you get all or most of your capital back, is a huge advantage.
And the virgin Dhandho, is that essentially where Richard Branson got into the business without a big investment up front?
Yeah, so I think if you look at, in fact, there was an announcement today, right? He's taking, I think, Virgin Galactic public, and it's kind of classic Branson. He doesn't. I mean, Branson throws a lot of stuff up against walls. If you look at the range of companies he's started and the number that have failed, it's a good sized number. But his downside in almost every case is very limited. So he's been really good at coming up with business after business where, like the Patels, he fixated on, well, if it doesn't work, what happens? And because of his fixation of if it doesn't work, what happens, what essentially happens is Virgin gets to make almost risk-free bets very frequently. So there's, like there was Virgin Cola, which has failed. There's a number of failures in the Virgin Group, but then if you actually dissect how much money they lost in those failures, it's usually pretty small because they do partnerships. Like when they set up Virgin Mobile, they did not set up their own network. They leveraged their branding and they came up with kind of unusual offers that appealed to people in terms of the way billing was done and the way customer service was done. But they pushed the cost of the network off on the kind of the incumbent carriers, if you will. So he's been exceptional at, and he's been really good at even looking at capital intensive businesses like airlines and getting into them without putting up capital. I mean, Virgin Atlantic almost had no equity put into it, and if it had failed, they would hardly have lost anything. And in fact, at that time, they had a music business that was doing really well and could have easily carried them even if the airline failed. So I think Richard Branson is like a cousin to the Patels in just the way his mind works, and a very similar approach in a completely different context and industry and continent. Still works.
Let's see if someone else on the line wants to come in with a question. And by the way, everyone can unmute on their own. Christian, go ahead.
Thank you, John. Hi, Mohnish. Thanks for some very interesting thoughts, and thanks for taking my question. It's really about how you assess when a business fundamentally goes from being temporarily challenged to structurally challenged or in sort of terminal decline. So, currently, if you look at the big consumer goods companies or much of retail, I guess that's a very current topic. So how do you sort of assess that?
Well, I mean, I think that a couple of comments there. One is that we have such a large choice, a large range of options when we're making investments. I mean, there are like 50,000 stocks globally. So I think one should be a harsh grader, and there are no called strikes in this game, unlike baseball, and you can let a lot of balls go. So we can do very well without buying consumer packaged goods or buying retailers. So if things bother you about, a lot of things, so capitalism by definition is extremely brutal. Pretty much any company in existence today will not exist. Maybe most of them will not exist even a couple of decades from now, or maybe even less than that. So the demise of virtually every business is guaranteed. So given that backdrop, I think what we as investors should do is we should be very harsh graders. And if we don't have a crystal ball that tells us that a retailer is going to be in great shape 10 years from now or 15 years from now, then unless you're getting it really cheap and you're only dependent on next, let's say 2 or 3 years of cash flow to cover what you're paying, for example, and you have kind of strong conviction on that, you can take a pass. I mean, there's entire industries you can take a pass on, not a problem. And I think you can also build plenty of wealth while just understanding one or two industries. So one doesn't need to have kind of Swiss Army knife approach to investing. There are plenty. In fact, if you look at most entrepreneurs, they've created their wealth with an extremely narrow skill set that they've capitalized on. I mean, they know. They are basically an inch wide and a mile deep, and that's a perfectly fine way to go. So better to be an inch wide and a mile deep than a mile wide and an inch deep. And so specialization has a huge advantage. And if you're questioning core structural aspects of industries, you can always take a pass, and there's no penalty for that.
Thank you very much. Thank you.
Does anyone else want to come in with a question? Feel free to just unmute your line if you do. Perhaps I'll ask one, Mohnish. In the Dhandho Investor, you talk about this concept of arbitrage, and I know it's slightly different than, let's say, when we think of M&A arbitrage. What do you really mean by arbitrage in the business context?
Well, I mean, I think that virtually all businesses that get started are focusing on what I would call offering gaps. So some entrepreneur sees an unfulfilled need, some product and service, and therefore starts a business. And kind of an example I used in the book was, let's say there's a barber in town A, and there's another set of barbers in town B, and these towns are, let's say, kind of 30 miles apart, and there's a new town coming up, town C, which is kind of in the middle of these two towns. And because it's a new town, there are no barbers in that town. Well, some enterprising barber in town A or town C will say, or town A and town B will say, well, I'm seeing some clients come in who are driving in from this new township. I think I can do better if I service them locally because there's no barbers there. And maybe I can charge them more because they save all the driving time. So an entrepreneur is going to see that's a kind of example of an offering gap where town C should have barbers, but because of the growth, it's got a void. It's kind of like what was happening in the fracking areas of the US, which were going through turbo growth. I mean, a lot of services were just not available because the growth was so aggressive. And so the barber sets up a small shop. Maybe he leases some space, some secondhand equipment, and is there 1 or 2 days a week. And then over time, he increases his time over in the new place as the business comes in. So that type of approach is an approach where the downside is very limited because the barber hardly put up any capital, and he took advantage of an offering gap. And so arbitrage basically, in effect, is the way pretty much all successful businesses get started and formed. I mean, they're going after offering gaps. And if you overlay that on the investing side, there are, so classic arbitrage is risk-free. Kind of, let's say gold is trading when we used to have these different prices of gold in different cities. In London it's at 1,000, and in Dubai it's 1,020 or something per ounce. And you could buy one place, sell the other, and collect the difference and not have anything at risk. That type of approach actually happens in investing as well. I mean, like, for example, I think this is going back almost like 14 or 15 years ago. I invested in a steel company called IPSCO, a Canadian steel company, and they had $15 in cash per share, and they had contracts where the next 2 years of earnings were going to come in at about $15 a share for each of the next 2 years, and the stock was trading in the low 40s. And so if you just took, and there was no debt, so if you just took the current cash and just added in the next 2 years of kind of contracted cash flows that were high probability of coming in, you basically were getting the entire business for free. So there was an arbitrage there, if you will. And because this business was very highly cyclical, it was entirely possible that after 2 years, earnings was zero or even negative. So that is why the market was pricing it at 2 times earnings. But in effect, I think that was a extreme reaction. And so, I bought the stock in the low 40s, and then it drifted up to the 60s in the next few months. And then the company announced they had one more year of visibility, again at $15 a share. And now the stock was close to 90 because you had now a little more visibility. And then some Swedish company came and bought it for 160. So in that situation, it was very difficult to come up with a scenario where you would lose money. I mean, to lose money, what would have had to happen after 2 years is not only would earnings have had to go to zero, they would have to go negative. And of course, the company has a lot of levers they can pull when that is happening. So that's an example of arbitrage. But I mean, what we're looking for even in investing is exactly what the entrepreneur is looking for. The entrepreneur focuses on risk-free bets, or as close to risk-free as they can get. And that should be our focus as well, is, look at opportunities where the downside is very muted. Like in the case of IPSCO, I mean, you had contracts, there were these pipelines being built, they needed those steel pipes, and the odds that they could just walk away were pretty low. And we find those are far more common than you would think they are.
And Mohnish, I recall also from quite some years ago, and I don't know if this would be another example of what you just described, but back in a former shipping industry crisis, I believe you made an investment where the company was trading for less than the scrap value of the steel. And so you had that as the downside protection, and eventually the cycle might turn.
Yeah, so I think that was Frontline. And, I was dumb and stupid then, because I think I made a 30 or 40% return on Frontline, pretty much almost risk-free. But, I bought the stock at like a $6 or $7, and I think I sold it for $10 or $11 in a few months. And it went to 140. And it gave some dividends, very significant dividends along the way, and it spun out a company. So I don't even want to think about how much I left on the table. But that was an example where they had the largest fleet of VLCCs, very large crude carriers, and they had a lot of debt, but the debt was non-recourse to the company. The debts were tied to the ships. So actually, at the holding company level, they really didn't have any issues. Each kind of vessel was its own kind of universe in terms of the debt on that vessel, and so on. And what happens in the shipping industry is very similar to what happens in, let's say, Class A high-rise office buildings. Is if you look at a place like New York or Chicago, downtown, for example, office space, economies boom, office space gets very tight, rent goes up, and then a bunch of developers look at that and say, wow, I can put up a tower or two and really make a killing. So what happens is there's lemming behavior, which is they all start constructing towers at the same time. And these towers take 3 to 5 years to come up. So they're all hitting the market at the same time, which of course depresses rents. And then, these maverick kind of real estate guys go from, being very exuberant to being very stressed, and, banks are foreclosing on them, and so on and so forth. And the shipping business is similar in the sense that to build a VLCC is a multi-year process, placing orders and such. And these Greek ship owners are probably worse than the kind of New York or Chicago developers, or where they vacillate far more quickly between fear and greed. So the moment they see that all the ships are busy and rates are going up, all of them just go crazy and place a bunch of orders for new ships. And of course, when these ships get delivered, you've got a glut and prices collapse and so on and so forth. And then the cycle kind of repeats itself. So Frontline found itself in a situation where there were too many VLCCs relative to the demand. But what the market forgot is that these VLCCs have a scrap value. And if you just looked at all the ships based on either what they could sell for then in terms of distress sales or what they could be scrapped for, and you took out the debt, you were significantly above where the stock was at. And that did not account for the fact that, so at the time I was making the investment for these VLCCs, I think the daily shipping rates were like $10,000 per VLCC, which at those rates, they cannot make money, they lose money. And so what happens when you have money losing operations is the older ships get scrapped. And as those older ships were getting scrapped, capacity kept getting taken out. At the same time, economies grew and the kind of curves crossed. And the reason why Frontline went to 140 is that $10,000 a day shipping rate went all the way to $250,000. And that wasn't the first or only time that happened. I mean, this kind of movement from 10,000 to $250,000, maybe not this much, 25 to 1, but you see very wide swings in terms of lows and highs. And of course, when rates are 250,000 a day per ship, markets go crazy, and they assume present circumstances will last forever. So anyway, I got one part of the equation right, which is I couldn't lose money, and which was correct, and I made some money. I did not get the more important second part, which is why don't we at least keep a part of this to see what happens when the market gets tight. And so it's a lesson learned, and I try to keep that in mind for the future.
And Mohnish, in the Dhandho Investor, you have a chapter on the art of selling called Abhimanyu's Dilemma. Could you reflect a little bit on that and perhaps how you might update it given another dozen years of experience?
Yeah, selling is always a lot more complicated than buying. And I use the example of Abhimanyu because there's a great Indian epic called the Mahabharata, I think written about 2,500 years ago. And there are two kind of factions of a family, large family, that are at war with each other. There's actually a big battle going on with swords and elephants and everything else in between, with thousands of troops and so on. And one of the sides arranged their troops in kind of a spiral formation, which is called a Chakravyuh in Hindi or in Sanskrit. And that Chakravyuh formation makes it very hard to inflict losses on that type of configuration in terms of being effective at going against them. And so we have our hero Abhimanyu, who, when he was in his mother's womb, Lord Krishna, who's in this story, is explaining to his sister, who's Abhimanyu's mother, how one enters a Chakravyuh and how one decimates it. And of course, his sister, what happened with her was she listened very carefully as he was giving the first part of the story, and then she fell asleep in the second part. So of course, the unborn baby only heard half the story. So, they were saying about 2,000 years ago that you can talk to unborn kids and they listen to you. So that's fine. But anyway, so Abhimanyu goes into the Chakravyuh trying to help out his losing side. And he has great success getting to the center of it and inflicting a lot of damage on the enemy, but he doesn't know how to get out. And in the end, he's killed. And it's similar to investing in the sense that it's relatively easy for us to get pregnant and buy stocks. And when things start unfolding about a business somewhat different than what we may have predicted, like, we had this question earlier about retailers or packaged goods companies, we may have had certain models in our mind, and then we are seeing actual reality on the ground is completely different. Then of course, if you're below your cost basis, then the question is, do you want to wait till you break even? Wait till you make some money, or do you want to just cut your losses and run? These become kind of challenging and difficult questions to answer. So selling is always a lot harder than buying, and it's more complicated because we don't have crystal balls that tell us what markets are going to do or what individual businesses are going to do, and so that's why I use that analogy. So it's very important before we buy a stock, to be able to write down maybe in less than 4 or 5 sentences why we are buying it and under what circumstances and pricing we would be selling it, just so that we have that clarity very well etched in our brains.
Let's see if anyone else wants to ask a question. Christian, go ahead.
Thank you. Yeah, so I just had one other question. In terms of what you say about limiting your downside, to what extent does that happen at the company specific level? So for instance, looking at the business model or the balance sheet of the companies you invest in, and to what extent does it happen at the portfolio level? So say, by some diversification or by looking at the liquidity of the securities you invest into. Obviously, the Buffett school says you don't want to diversify excessively, but at the same time, I guess there's unknown unknowns, and no matter how much work you do on a company, things can go wrong. So how do you sort of balance those two, the company specific and the portfolio level? Thank you.
Yeah, I think it's a great question. Yeah, I think my natural tendency is to concentrate. And I think the one thing that I learned from John Templeton is that even the best investment analysts will be wrong kind of the majority of the time. More than 50% of the time, your decisions are going to be incorrect in terms of what actually happens with the stock versus what you thought would happen. And that difference may or may not lead to a loss, but it's certainly different from what you may have predicted. So companies are very complicated entities. They are in very competitive spaces. Capitalism is brutal. And so the future trajectory of businesses you invest in can be pretty wide from what you may have forecasted. And yeah, I think on a portfolio level, I mean, some things I have always done is I don't use leverage at all at the portfolio level. I'm not shorting anything because that also is kind of infinite downside. And we don't use derivatives in our investment funds and such. So basically, we keep it vanilla in the sense that if a portfolio position has a problem, it cannot cascade because of these issues. Its loss is limited to the, I mean, the worst case would be limited to the entire position size and such. And so I think if you've got 10 or more positions, and hopefully you've been careful in your selections, you may not have more than one or two that give you serious problems every 2 or 3 years or something.
Okay, thank you for that. Thanks for your thoughts.
Mohnish, just to follow up on this notion that the Dhandho investor has now been out for a dozen years, and you've had experience to learn from successes and mistakes in that time. How would you perhaps update the book? Would you add anything to it? Are there nuances that are not in that original version, but that would be in another edition?
Yeah, I think one of the things I would correct is there's a mistake in the book in the way the Kelly formula is applied. And the Kelly formula actually is not very relevant to equity investing or value investing as most of us practice it, because the underlying assumption is that you can make the same bet kind of thousands of times. Kind of like, if the odds of a heads is 51% and the odds of a tail is 49%, and you get to bet that once, if you just get to bet that once, it's not very useful to have that kind of edge. But if you get to make that bet 10,000 times, and you can always bet on the 51% each time, you'll do very well. So the Kelly is useful when you get these, serial betting opportunities, which is quite different from the way equity investing works. So one of the things I would change in the book is I would completely take out the entire discussion on Kelly because it's not relevant. The other thing I would do is I would probably spend more time on the downside protection and the free lunches. I think the thing is that the book does talk about how markets hate uncertainty, and they confuse kind of risk and uncertainty. And so, Frontline, which was the VLCC company, had massive uncertainty, but it had very low risk. And so when you have the combination of very low risk and very high uncertainty, the same thing in IPSCO, the steel company, extremely low risk, extremely high uncertainty. Usually the combination of those two will mean extremely high rewards because markets will misprice those quite significantly. And so if you have an edge in terms of understanding those businesses and like understanding kind of the dynamics, then it can work out quite well. I don't know whether I should mention this, but I'll go on a limb and say this, but one of the businesses that I think we're almost at the tail end of buying is a company which basically in the next 5 years will generate cash flows equal to or higher than, actually probably higher than the market cap. So in effect, and those are pretty much just like IPSCO contracted cash flows. So they're locked in. So it's not just giving a multiple. You actually have visibility into kind of 2022, 2023 type numbers, and the company is probably going to dividend out these cash flows as they come out. So for example, if I invested $50 million in this business and $50 million of cash flow, or maybe $70 million of cash flow will come in the next 5 years and that entire 50 or 70 million gets pushed out, then in 5 years I've got my money back. In fact, some of that started coming back a year from now. But I still own the business, and I still own all the assets and plants and equipment and all of that, just like IPSCO. So I like those types of bets. I cannot tell you what that business is worth, but I can tell you what the floor is. And we're buying below the floor. So that's quite exciting. And anytime we get to make these kinds of bets where, and this is again, now I think I have more experience than I had when I was doing frontline, etc. Is we have very low risk, we have very high uncertainty, and I think the next part of the equation, which is a likely high reward, is in the cards here. We will see how it actually plays out. But if it doesn't play out, with the bull case, in this case, we won't lose any money. We probably make some money. But if it works out with the bull case, then we make a lot of money.
Of course, we want to know the name now, Mohnish.
Yeah, so we cannot go there right now. But at some point, you guys will figure it out from the filing. So that's okay.
Absolutely. You did mention frontline there in this context. So
I think the filing is mid-August and for the end of June. And so I think by then I'll be fully loaded and really don't care what happens at that point.
Wonderful. Does anyone on the line want to ask another question before I have one more before we finish up? Simply unmute your line if you'd like to jump in. Mohnish, I think I'll ask just as we're finishing up, and I would be remiss not to mention Dakshana, because I've been watching your work with the foundation since you started it, and it's been just amazing the impact that it's had. And since we're talking about the Dhandho investor, I think in the not-for-profit space, isn't Dakshana really a great illustration of Dhandho? Because I think for the amount of money that's actually gone into it, the impact it's had is just amazing.
Yeah, no, it's worked out wildly better than I would have dared to predict. But it's worked for a number of reasons. One of the things is that we copied a model that had already been proven to be very successful. So cloning is very powerful. We didn't go into cloning much in this talk, but Dakshana is a good example of cloning. Pabrai funds also is a good example of cloning because we cloned the Buffett partnerships. So I have gained a lot of advantage in my life from the mental model of cloning. But the second thing that we did in Dakshana, which a lot of nonprofits don't do, is in a capitalist society. So let's go back to our barber in town C. If that barber gives bad haircuts, he's not going to be in business for very long, because people will just try him once or twice and then say this guy's an idiot, and they'll go back to whoever else they were using, and even if that means a longer drive. So capitalism has what I would call a natural feedback loop, where if you don't deliver value, eventually you're going to go out of business, or you will just not be profitable, etc. And it'll show up in the numbers. In the non-profit world, there is no such feedback loop. So if I am, for example, the Ford Foundation, and if I've got, let's say, a $10 billion kind of endowment or portfolio, the law requires me to spend 5% a year, which is, let's say, 500 million. And no matter what happens to that 500 million in terms of effectiveness, next year there'll be another 500 million available. And the year after that, there'll be another 500 million available, because the odds are that they can probably generate more than 5% a year on average in investment returns. And if they're generating more than 5% a year and they're spending 5%, they can run for 50 years with terrible kind of outcomes in terms of what actually is helping society. And unfortunately, that is the norm in the nonprofit world, where almost all nonprofits operate without feedback loops. And one of the reasons they operate without feedback loops is most nonprofit activities do not lend themselves to quantization to measure effectiveness. So what I did is I did an inversion. You know, Munger says, when you see a problem, invert, always invert, and it'll get you to a better place. So I inverted the problem, which is I said, look, in the nonprofit world, it's very hard to measure outcomes. So what I'm going to do is I'm only going to look at endeavors where outcome measurement is very easy. So I flipped the problem, inverted the problem, and said we'd only look at those things where we get the same feedback loop like in a capitalist society. And what Dakshina does is we help kids get into elite colleges like IITs or AIMS, whatever in India. And getting into those schools is really hard. And we, in effect, get an independent grade on how we are performing based on the number of kids that get accepted. And we have no control over that because it's an independent entity. Just like a barber delivering bad haircuts, just look at their financials, you're going to see the real picture of what's going on. And so because of that feedback loop, Dakshina is able to do two things. One is we're able to measure our effectiveness, which is we can see what dollars went in and we can see what is the outcome. And the second is we can make changes. So when we see that our success rate is lower or whatever else, we can drill down and tweak the model to, because we know what the factors are to get better outcomes. And that is extremely important. And I get contacted by a lot of nonprofits. And when I tell them this, I think they get they stop listening, because what they would have to do is completely hit the reset button on all their giving and start over. And that's just from their perspective too hard. So I was just lucky that, I had overdosed on Buffett on this subject, and I was aware that giving money is a lot more difficult than making it, and giving it away effectively is difficult. And so Dakshina created artificial feedback loops, and those have been great.
But what I think is also fascinating is that with this kind of thinking, I think you really, or you are being copied now, not by not-for-profits, but by people like Lambda School and all these startups where essentially they're investing in talent, and then the payoff is coming once this talent actually has marketable value.
Yeah.
And those guys are doing it in a for-profit way, and I think it's basically mimicking what you've been doing.
I think what is happening with us is, when we look at some of the cases, and some of these are outliers, but we have a guy at Google in Mountain View. His family was at less than $40 a month. Many times he said that all they could afford for dinner was, boiled rice and pickles, and many times it was just pickles. They had nothing to eat, no dinner. And I don't know his exact comp. He's about 26 or so, but I think he's north of $250,000 a year. So the thing is that it costs us $2,000 to take the family from $40 a month to like $20,000 a month. A payoff in, you can say, 3 days, after he starts working for a few years. So the ROIs of Dakshina, because, I'm not even measuring lifetime income. If I take someone like that guy and try to measure lifetime income from 22 to 72, he was just working on a project directly with the CEO of Google. I don't even know where that's going. So so we have, it's actually very, very heartening to see that. And I think Dakshina, because we focused on it so tightly, nobody else was in this space. No one else is even still in this space because humans are bad cloners. We've tried to advertise our model. No one else wants to enter. That's fine. And so we get tremendous ROIs on Dakshina with what we're doing, and it's very satisfying. But the thing is, if you really break it down, I'm just a kid who likes to play math games. I play math games on the investing side, and I'm playing math games on the giving side. And all I'm trying to do is make sure that one day before I die, hopefully everything I made is gone on the other side. And that'll be kind of fun to do that. I hope the day I'm gone is very far away, and I hope those numbers are large, but we'll see.
Well, on that note, Mohnish, I think you've certainly been extremely good at playing math games, both on the investing side as well as the nonprofit side. And we look forward to a lot more of it in the coming decades.
Thank you, John, and thanks for your support. And I think you do a great job. Manual of Ideas does a great job for the community. I think you deliver just incredible value versus what we are paying for your services. So thank you very much for what you do.
Mohnish, thank you so much for your time. As always, it's such a pleasure to learn from you, and it's conversations like this that give me benefits that are maybe not measurable specifically, but are immeasurable. And I think that's really what this is about. So thank you again, and thanks to everyone listening. It's been a real pleasure. Goodbye for now.
Great, thank you.